Assalamualaikum guys, welcome to my YouTube channel. We are talking about co- insurance policy. Now start. In insurance, the insurance policy is a contract, generally a standard form contract between the insurer and the policy holder, which determines the claim which the insurer is legally required to pay. The exchange for an initial payment known as the premium. The insurers the insurer promises to pay for loss caused by perils covered under the policy language. Insurance contracts are designed to meet specific needs and thus have many features not found in many other types of contract. Since insurance policies are standard form, the insurance policy feature boil, boilerplate language, which is similar across a wide variety of different types of insurance policies. The insurance policy is generally an integrated contract, meaning that it includes all forms associated with the agreement between the insured and insurer. The same cases, in some cases, however, supplementary writing such as letter sent after the final agreement can make the insurance policy a in integrated contract. One insurance textbook states that generally courts consider our prior negotiations or agreements. Every contractual terms in the policy at the time of delivery as well as those written afterward as policy writers and endorsement with both parties consent are part of the written policy. The textbook also states that the policy must refer to all papers which are part of the policy. Oral agreements are subject to the oral evidence rule and may not be considered part of the policy or if the contract appear to be whole. Advertising material and circulars are typically not part of our policy. Oral contracts pending the issues of a written policy can occur. General features. The insurance contract or agreement in the is the contract whereby the insurer promises to pay benefits to the insured or on their behalf to a third party if certain defined events occur. Subject to the opportunity principle, the event must be uncertain. The uncertain uncertainty can be either as to when the event will happen. E.g., in a life insurance policy, the time of the insured death is uncertain, or as to if it happen all at all. E.g., in a fire insurance policy, whether or not a fire will occur at all. Insurance contracts are generally considered contract or addition because the insurer draws up the contract and the insured has little or no ability to make material change to it. This is interpreted to mean that is the insurer bears the burden if there is any ambiguity in any terms of the contract. Insurance policies are sold without the policyholder even seeing a copy of the contract. In 1970, Robert Keaton suggested that many courts were actually applying reasonable, reasonable expectation rather than interpreting ambiguities, which he called the reasonable expectation doctrine. This doctrine has been controversial with some courts adopting it it and other accidentally rejecting it. In several jurisdictions, including California, Wyoming, and Pennsylvania, the insured in bound by clear and consistent terms in the contract, even if the evidence suggests that the insured did not read or understand them. Insurance contracts are arbitrary in that the amounts exchanged by the insured and insurer are unequal and depend upon uncertain future events. In certain in contract, ordinary non-insurance contracts are commutative in that the amounts or values exchanged are usually independent, intended by the parties to be roughly equal. This distinction is particularly important in the contract context of executive products such as finite risk insurance that certain commutative provision insurance contracts are arbitrary, meaning that only the insurance makes legally enforceable promises in the contract. The insured in not required to pay the premiums, but the insurer is required to pay the benefits under the contract if the insured has paid to premiums and met certain other basic provisions. Insurance contracts are governed by the principle of utmost good faith. Eubemia fights Eubemia vibes which required both parties of the insurance contract to deal in good faith and in particular impart on the insured a duty to disclose all material facts that relate to the risk to be covered. This contrasts with the legal doctrine that covers most other types of contract. Caveat emptor let the buyer beware. In the United States, the insured can show that an insurer in tort for acting in bad faith. Thank you for watching my video. Like and subscribe my channel.